another group, and they had partnered on this new construction deal. And it was literally everything that could go wrong in terms of macroeconomically. Again, not a distressed property, distressed really a capital stack. You went wrong. They took a construction loan out, which is a floating rate loan with no cap, right? Which to me seems insane, right? Because even when we did our couple of bridge loan deals, we still took out an out of the money cap, which helped us for 2-3 years. They did. Then you had typical stuff at supply chain new construction for post COVID. They were impacted longer than typical average person was, right? So everything got delayed in this project. Not crazy, 6 to 8 to 12 months maybe, right? You were on site. Things are, nothing looks like it's like a ghost town. They're working.
Beautiful. I love that.
They ran out of cash, right? And time. So they need to get out of this loan. And they took pref in the meantime to try and buy themselves some time to make the payments, just kind of further digging them in a capital stack hole.
Sure.
So their loans due, and even just like to finish out certain things in construction, like to fund operations during the lease up, they have no money left. So that's when they came to us. Then we said, listen, we can get involved here, but we understand. So essentially, they just kind of borrowed more money, right? And now they're in a position where they could go bridge to bridge. They'd have to convince a lender why they should be trusted to do so, right? But they'd be very, very over leveraged. They don't have the money to refinance the loan, nor do they have the money to fund operations during a lease up.
Yeah.
And now is not really the best time to be exiting a deal when you need to optimize pricing. I think they could sell, I think, for more than their construction costs, where the problem is that their costs are already well above where construction costs kind of were, right?
Right.
So that's when they reach out to us. We say, listen, we'll come into this, right? We'll give you the money to write. So our money's going to be doing a few things. And I'll show you kind of on a picture and what our money's going to be doing. I'll show you the model. I'll show you another great graph we put together. Our money's going to be used for a few things. Number one, our money's going to be used to right size the loan. So we're taking the loan down from like a $76.5 million loan and a $4.5 million pref slug they took out to help them fund. So basically they're sitting at, $81 million. And even if they took out a bridge loan, they'd have to sell out of the bridge. They wouldn't be able to stabilize and sell maybe in a few years, which would be advantageous years to maximize pricing, because no perm loan isn't taking out that high leverage. So we're going to be what's called right sizing the loan. We're taking the leverage down. We're de-risking the property.
Yep.
So that means we're paying off the pref, the $4 million pref, and we're paying off about $10 million or $9 million, really, 9.3 of their loan. We're refinancing, but we're taking out a $73 million loan, $76 million loan, and putting in a $67 million loan.
Okay.
The benefit then is when we finish lease up and now we're stabilized, we can then put in a Freddie loan, an agency loan, a lower leverage point, their lower leverage point compared to what could have been a bridge loan, and stabilize the fixed rate debt and just operate for 3 more years, push the most we can, and have those 3 years to optimize when we exit.
Yeah, that makes sense.
So that that's already, I've already counted for now 9.3 of a loan right size, and plus that's 13 million of our money right there. Then we're also funding operations, right? This thing's not going to cash flow until it's, I forgot what it was, like 45, 50% occupied, and it'll start to really break even. So we got to fund it till then. And that's what a lot of the other money is being used for that we're putting in.
Okay.
And then to go to counter that was, we'll get involved here, but obviously our total costs are going to be bloated, right? There's more money going to this than it should have to go into for a typical construction. The only way we're getting in is we're sitting ahead of the existing equity on the capital stack. So all but a couple of relatively, a few $1 million of their TIC investors, which have to be put kind of for legal reasons on par with us.
Sure.
We said to them, listen, we'll come in. When we sell it, all the money first comes back to all the Viking investors. Next, we need, and again, they have like a few million that they're getting pari passu to us.
Sure.
Next, though, we need a 10% return to all Viking investors before you guys even see anything. After that, you guys can get paid your capital back. And after that, we see everything till 18 IRR. And then after that, we're going to split 75-25 with them. Although I don't project there's going to be that much more left after it'll be an 18 IRR to be honest. And they know that.
Yeah.
It's what's called the hope note, right? They're hoping, and they can tell their investors, if we knock it out of the park, we'll actually make some money here, but we'll get our capital back. That's the win for them, which is a pretty big win.
Yeah, no doubt. Yeah. I'd be pretty happy about that.
That's the story here. Now, again, let's just say this thing is now all in for construction costs. I'm talking real construction costs, not like the loaded costs of, I don't know, around 110 million, 108, 115, somewhere around there. if this thing were to just, flat out sell for its cost of construction, right? Which would be a pretty insane downside scenario. Vikings coming in at a $67 million loan plus our own equity. We're coming in around $90 million, right? We're then basically getting our money back.
Yeah.
So like the downside scenario, and again, apocalypse can happen, right? But this would be a pretty apocalyptic scenario if they just sell for construction costs. New construction doesn't sell for construction costs. That's why it's done. We're de-risked in terms of our capital, right? And then if it sells for kind of the very low end of where kind of stuff trades back in Arizona, again, things trade higher there because there's no tax readjustment, right? They're capped at 5% increase. Insurance there, they don't have bad weather. They just have hot weather.
Yeah.
So things do, their OpEx is lower. So, and same cap rate, you get a higher price per door. That is, even if on the lower side, we're still getting a 10, 11, 12% return. If this thing sells where it should sell for, well, then we get a good return, right? And if it hits out of the park, we can get, a great return. So it's really the theme here is, given what we've experienced in our own portfolio, we've seen out there in the market, the attractiveness is a truly risk-adjusted opportunity. And then you get on site and you see it's actually, wow, this is a beautiful property, right? This thing's going to lease up.
Yeah.
This thing should sell for market pricing. We just really like that risk-adjusted return. Now, granted, some people will say on a new construction, if you really knock it out of the park, you can get a 3x multiple. Well, that hasn't happened in a couple of years. But then again, their downside risk is a lot lower, right?
Yeah.
So, man,
Yeah.
that's the theme here. And I'm happy now to kind of answer any questions there, or we can kind of just kind of
Not do with all that stuff, Chris and them, but that was a great explanation as well. Give me a little bit different flavor of things, but it's more of, understanding the fund to fund. And on that downside with the fund to fund, how does that work? Because then my investors are getting that 10% IRR, but there's no spread. So what do the fund managers get in that scenario?
well,
I know. I started thinking about it, like, well, yeah, that's good because but there's only 10% straight. There's no different classes. It's just this is what everyone kind of gets.
right. Listen, Vikings in the same boat,
Yeah.
right? If this thing gets knocked down and we're only seeing a 10% IRR, I'd have to imagine Vikings taking a haircut on a lot of its upside too to make sure our investors get something, right? So on the downside scenario, yeah, it's a downside for everybody. And we have to figure out how we're going to kind of, share things with, everybody, right? And if we all get, and I forgot how the fund to fund works, like the fee into it, right?
Yeah.
But if on a downside we got a fee and no upside, that's again a pretty good downside scenario.
Now when you say Viking gets a 10% IRR, a minimum, that's probably could be worst case before they get the $30 million back or whatever the number is.
Yeah.
I was under the impression that it's not just Viking, it's Viking, you mean Viking and the investors get the
I mean the Viking coming into this deal.
Okay. Right. Right. I just want to make sure I wasn't then had to be, diluted as
Yeah.
well.
And I'll be honest, I mean, that's something, I forgot it was in the deck, right? I think we were clear, like, I don't think we told them downside scenario what you guys are getting, right? So, downside scenario, we can still slice and dice it appropriately. So, hey, doomsday hit, you guys are seeing a 7% return. Again, pretty good doomsday scenario, a nice 7 return over a couple of years. And there's still room to share with fund to fund groups, right?
Okay. Yep. Yeah, just how it works. So yeah. So that'd be great to see the actual new fund to fund.
Yeah, I don't know. Yeah. Okay. So let's jump into this. You guys looking at my screen?
Yes.
Yeah, we can see it. Oh, yeah. We can just zoom out a little bit. So just to come kind of top down here. So,
Sure.
oh, it's in 9 right? Here we go. All right. Gotcha. This is a little bit of a Frankenstein model just because we kind of, it's a little atypical of the structure. We may never use structure ever again. So, but here's where really the meat and potatoes is in the source and uses. That's our existing equity here. That's our existing equity here. It really shouldn't be in the source and uses because it's not a source. It's not coming into the recap. And it's not a use. We're not paying them off, right? But for the purposes of the model working, because they are involved in the return structure, we have to account for them somewhere. And we're not hiding them, right? So that's them. Here's where the money is going. We're paying off a $76.5 million loan. We're paying off the 4.5 in pref. And the pref has a bunch of deferred payments that they haven't even made yet. So it's almost getting closer to $5 million in pref fees. There's the AC fee coming to Viking, which again, this is on our basis, which is, the 90 or so $1 million basis. Usually we're at 2.85% AC fee and a 50 basis point sponsorship fee. That's, 3%. We'd be a lot higher. We'd be 2.69, I think. So it looks like a big number, but fee wise, it's like It's actually almost a full percentage point less than we usually take. Operating reserves, so it's a lot of reserves going into this one. And now where we end up, right, is a $67 million loan. So again, almost $10 million less, and certainly relative to the capital stack and everything, it's de-risked, loan to cost, loan to value. It's just a much better position to be in. And the rest of it's obviously going to be in equity, but common equity, right? We're not sitting behind it for a larger loan. So it's kind of a de-risked position. And then the game plan is pretty straightforward here, right? I mean, you saw the property. The interiors are pretty much done now. It's already been 4 months since we've been out there.
Yeah.
Feels like it was yesterday, but it's been
It's crazy.
May, June, July, August. Okay, about 3 months. Make the assumption here: vacancy loss. I'll show you that. I'll show you that annually, and I'll show it to you as a percentage because it'll be easier also to see that way. Here we go.
Pulling it up a little bit, maybe to like one.
Yeah, sure, no problem.
Yeah, thank you.
So economic occupancy, which obviously throws together all the types of economic occupancy. You go from zero. This is, by the way, this is the way our model works. It's by the end of year. So it goes from 0 to 32%, 74%, then into the 90s. Can we outperform 91, 92? I think we can, but let's leave it there.
Sure.
And so there's vacancy, which trails down from 4 million to 400,000.
Yep.
Non-revenue units, like the models, those kind of stay the same. That actually grows as rent grows, right? Because the value of your model goes up that you're not leasing up. Bad debt starts at nothing because no one's in the building yet, right? And then we assume there will be some bad debt. And I'll show you a percentage. It's inevitable. Also, this is Avondale. It's not Scottsdale, right? It's a good area, but it's a BB plus market. It's not an A plus market. And then concessions. Concessions start pretty strong, as any lease up will, when you're offering incentives to lease it up pretty quickly. And then that's part of the reasons we would not just sell it in year 2, but we'd like to operate it after lease up for another couple, we're stabilizing kind of in year 3.
So do you have higher concessions in year 2 because you're going to be doing more lease up going on? Is that why it goes
Correct.
40 back 20? Okay.
Right. All the units will be online. They'll be leased. Until a unit leases, concessions don't hit the books.
Yeah.
You want to build in the maximum that you're going to use. But obviously, if in year 1, lease up goes way better than we're expecting, maybe we're not spending $527,000 the next year. You have to assume that there's a use case where year 1 doesn't go as well as we hoped.
Sure.
And year 2, we need to have the ability to ramp up concessions to accelerate it.
Yeah, that makes sense.
And look, theoretically, if this went up to 700 year 1, that might be good because it means we're ramping up leasing much quicker, and then it'll sell off much faster. We'll stabilize faster, and then maybe we could actually sell earlier.
Yep.
Again, this other income, right, rubs, all this kind of trails up as we occupy, right, as we get everyone leased up. And then expenses, obviously, we have them pretty much from the get-go where they should be. Now, the reality is that some of these will trail up a little more. Utilities will start lower.
Yeah.
We have our full OpEx right away, so we're prepped for it. But realistically, there's not going to be a lot of water usage if no one's in the apartments yet, right? So this, again, I will start on this one. But otherwise, and again, turnover is going to ramp up, and that we do ramping up because number one, when you're brand new, your turnover is less. I mean, there's a hard top surface and you're not changing counters, but also you're not turning over the old leases. They're all new leases.
Yeah.
Can you touch on the expense ratio? Because I did a webinar on this deal yesterday, and one of the questions I answered, and I gave an answer, but I told them, like, for investors that were listening to reach out and that we get an answer from you. And I know that you had written out a really concise answer that I couldn't recall, but they pushed back on the expense rate being it's beneath. And I just wanted you to cover that just in case investors are watching this.
Yeah, no problem. So this one, we had a long talk with our asset management about this, and Edmund Archuk, our director of asset management, who also has done 20 plus ground up projects himself. New construction. And by the way, for all the listeners, and Don, for you also, I saw this. It even caught my attention because as an acquisitions guy who's focused most of my career on stabilized product, if a broker showed me this, I'd be like 25%. But here's the reality. There are a few reasons why that's achievable on this property. Number one, it's new construction, right? So your R&M is going to be lower, right? Your AC repairs, a lot of this stuff. If I was saying, hey, what's this going to look like now? Year 10, so 6, 7, 8, 9, 10. If we were looking at this kind of down here, I would say this is going to start to go up because in year 10 is when you start having roof repairs, you start having your HVAC systems going, you start having, not replace them yet, but where you're making a lot more repairs because replacing the capital costs, right? Your OpEx and R&M will go up. You'll start to see also your landscaping becomes mature, right? Anyone who's like, I hate this. I'm looking in front of my house right now, right? Planted a bush, right? There's a nice little bush, and now all of a sudden it's huge, and we have to like cut it down 10 times a year. I'm like, do we just get rid of it and put a new small one in? But all this stuff, as your property matures, you will have higher OpEx costs. So that's number one, because everything's very new. Your R&M, your contract services. Again, real estate taxes, they're not going to be able to be adjusted in more than 5%. So we're not getting a big tax bump that a lot of new constructions might have. Insurance is also lower in Phoenix than other markets because there's no hail, there's no rain, right? There's no dust storms. It's just hot, right? Which has its own challenges. Our landscaping, I don't say our landscaping, we have dry scaping. If we tried to have lush green grass, we'd have a ton of water bills.
Right.
But we
factored in for landscaping on this one.
we have a lot of hardscape. We do put irrigation in, but it's a lot of hardscaping.
Yeah.
So, that's one reason. The other reason is our finish quality. So on the interiors, we're doing LVT flooring and we're doing hardtop. So typical turns are going to include new carpets and resurfacing or respraying countertops. In this quality construction, you don't have either of those.
Oh, yeah.
So that's two big turn costs. And those are probably the two biggest turn costs, right?
Yeah.
Aside from repainting. And that we have built in. So those are lower for those two reasons. Again, if our typical investor / myself, I'm used to looking at stabilized product, this will be into the 30s for well managed. But
It was an adjustment for me too, because most of the things I teach on is P's and C's. Yeah.
and by the way,
45, like 30s. How are they doing it for 30? Didn't realize.
per unit, we typically see in the 7s, max of 8 OpEx per unit. We're at 7 here basically. So we're not way off on a per unit basis.
Right.
But again, there's a reason for that. So thanks, Chris. I'm happy.
I wish that I could say that yesterday on the webinar. It would have been.
It's just a reason for a follow-up call.
Because I have to have Jude on every single one now. Kidding.
And I told Chris when I joined Viking, and I was, it was 4 of us. We got a deal, and it was all hands on deck. I was doing investor calls, not as many as Chris does now, but I was on them.
Yeah.
If an investor or donor, you want to look kind of at a more granular level of it, and on a percentage basis, the monthly cash flow breaks it out very nicely.
Yeah, I love that. I just want to ask you one question on that. Do you have that for Avondale Hills? I asked Hayden yesterday.
We do have a month. All our cash flows are broken down monthly. Also, it's not as dramatic as a change because it's already fully out.
Yeah, I don't have it in my underwriting model. There's fully cash flow tab.
All right,
We want to see if I could get that if possible.
it exists. We'll make sure you can get access to
Okay,
it.
great, thank you.
And it just kind of shows, right? Again, your vacancy trails down really pretty conservatively. I think that, this is even, by the way. If you do the math, this is very even. But again, we expect come the spring to have actually more accelerated leasing. And then there could be a slowdown. So this is just kind of really just evened out.
Okay.
Concessions, again, they ramp up as leasing ramps up. And same thing with bad debt, right? It's very low early on because, everyone's fresh and new and paying. And over time, it'll get up to 1%. And then that as a nominal number will grow as over 10 units are leased. Now we're getting to our 95% physical occupancy. We had the end of the year, the very end of year 2. And that's when things are stabilized. And we actually don't have rubs above 55%. I think we're going to get this closer to 80, 90 as we do in most of our.
Wow, that's great.
Yeah. I'm trying to think what else here to go through. Yeah, the rest of it's easier to see in the annual tab. And I think it's worth jumping back to the annual, just kind of show the business plan. I'll zoom back in.
And you guys are thinking this is the nicest property, even compared to those ones that you covered in the webinar, the ones that were more on the high end?
From looking at it, again, the area, I think so. We're still delivering, but it can compete with any of them. And also, I don't know how those are built. The fact that this one was built and there was an EV charging port, and they haven't put the equipment in yet. They're putting a few in. They're ready. If this world goes electric in 5 years, there could be a port at every building, right? And this thing's ready.
Wow, that's awesome.
Yeah. Year 2, I can go which month, but towards the end of year 2, right when we stabilize, we're taking out the old loan, putting in a new loan. We're not looking to cash out. We're looking to just get a replacement loan as low as we can. We'll then have IO coming in. So which is nice on that loan as well.
So you're going to go to a permanent loan at that point, a 5-year loan.
Yeah. And eventually when we sell, we're going to be paying off that loan. So that's kind of the timeline.
On the loan, because I know folks are going to ask about this. What are our assumptions on that loan? Like, what did we model out for that replacement loan as far as rate and duration and IO?
Yeah. So month 24, the end of year 2, we have a 5.25% interest rate. We can get 5.25% now, right? So I just going by the news, right? Where they're expecting a September rate cut, they're expecting a rate cut, whoever comes in for Powell in April, and this is 2 years away. So I think this is being conservative. I think we're probably still going to stay the same loan refinance, right? And we're not looking to cash out here. Although if we could, I'm not saying we wouldn't, but we're assuming we just go straight. I do think our cash on cash going forward then might be a little stronger, given that we will have lower debt service. 30 years amortization, 3 years IO. We're going to do a 5-year loan, more percent fee on it. Again, I think we can probably beat them down to 85 basis points, but leave it at 1% for now. And yeah, we're going on a T3 valuation, which I think any of the agencies would. 6 cap on valuation. I think that's being conservative. 70% LTV. I think we're being constrained here though by what's called debt service coverage. I think here, even in this scenario, I think we're even assuming we have to maybe even use some of those reserves for cash in on the refi, but we have it all built out in case we have to.
No prepayment penalty on the new loan?
No. So we're going to get a 5-year loan. We might take a little bit of a higher spread on the rate only to give ourselves that 3-year yield maintenance and not 5.
Yeah.
And then if we pay off a 3-year yield maintenance in year, which would be, that's year 5 for this deal, 2 years for each 2 years. We paid off in year 4, and you're not going to be dealing with yield maintenance. So it gives us the flexibility.
Yeah. All right.
This is at least, I mean, yes, theoretically this would be a 3-year hold, but I'd imagine it's at least a 4.
Perfect. Well, and this is what I wanted. I wanted everyone to see that we weren't projecting out what we think is going to happen with rates, that we're going with what today, which I think most people would agree is conservative.
And then let me just get to it. This is not our typical model where we have our exit assumptions. 1 second. I'm going to find it. Oh, here we go. That's right. We looked at before. So again, exit cap rate, 4.5 cap. I think you're seeing this new product right now trade still in the low 5s. And that's with these rates. I think we'll have the optionality to be able to capture this by year 5, maybe year 4. I'm 75 basis points closing costs at this deal size, right? We're talking about $146 million exit. Your percentage-wise, it's sliding scale. The brokers aren't taking 2% on that size, right? So our closing costs as a percentage do go down a little bit. Yeah, that's...
So the broker's only going to charge like that fees, 0.75% on a side.
No, they'll probably be less than that.
Oh, really?
Be less than that. Yeah. I mean, because I first talking for $140 million. I mean, I'm sure we can, even if they get like a $450,000 fee, which is a nice fee, that's less than half a point, right? So they'll be way down on their points. Yeah, exit price $450 a door. Again, height of the market. So granted, a different world. I was seeing 80s product trade for high 3s a door in Phoenix because everyone's offering the same cap rates and just your tax is lower, which we discussed before.
So on the left side, you have the existing capital stack. This is pre-Viking, the existing equity, the pref, and the original debt. Then you have what the recap looks like, where the existing equity is the same. Then you have Viking's equity, and then you have the new debt. Here you have the waterfall. So you have the new debt is going to be in the first position. Then you have the Viking equity. Then you have Viking's 10% IRR. Then you have the existing equity getting their capital contribution back. And then you have 100% of the profits going to Viking getting the 18% IRR. What we don't show is past the 18% IRR, the original equity being able to split 75-25.
We're the 75 on that. Just so
So that's like if we got a 25% IRR, this thing does way better. But like this, we haven't quite finished this yet. Like the latest iteration of this is going to basically have exit pricing that would be needed. So basically what cap rate we would need to sell at in order to satisfy each tranche of this waterfall.
Okay. I think that'd be helpful.
Yeah. But that's it.